natural gas futures edged lower on Monday as traders responded to a bearish mix of robust storage builds, sluggish LNG export demand, and limited short-term weather-related consumption. The front-month contract retreated after last week's gains, with market fundamentals now clearly favoring the bears. Interestingly, natural gas prices showed a notable disconnect from fundamentals last week, as investors focused on forward-looking factors. Despite a seemingly bearish 122 billion cubic feet storage injection on Thursday, prices dipped only briefly before surging sharply on Friday to close out the week on a strong note. Gas demand will remain limited in the coming days as weather systems move through the Midwest, Ohio Valley, and parts of the East, bringing mild highs in the 60s to low 80s. While California and the desert Southwest are heating up, with temperatures reaching triple digits, much of the U.S. is experiencing only modest summer conditions. This keeps national cooling demand subdued and undermines the bullish case based on weather-driven consumption. Although a hotter pattern is expected to develop later in the week, it has yet to offset the bearish pressure from strong supply levels. Weak U.S. LNG export demand is further contributing to the bearish sentiment, with volumes reaching just 13.5 billion cubic feet per day on Monday. Exports remain muted due to ongoing maintenance at two key Gulf Coast facilities, Sabine Pass and Cameron LNG. Cameron's outage has extended beyond the typical one-month turnaround period, restricting output. While increased flows to Freeport and Plaquemines LNG provide some relief, they haven't been sufficient to offset the broader export slowdown. With robust storage builds, weak LNG export demand, and minimal weather-related support, the short-term outlook for natural gas remains firmly bearish. Traders should keep an eye on any signs of expanding heat or a recovery in export volumes, but until those materialize, price rallies are likely to face resistance. Technically, momentum is trending downward, with the 50-day moving average near $3.50 serving as the next downside target. On the upside, gains remain limited by resistance at $3.80, a level that bulls have repeatedly failed to break since April. The key resistance level remains at $3.90. Please like, subscribe, and comment to support the channel. See you in the next one.